Welcome to Smart Stock Watch, your go-to channel for in-depth financial analysis. Today is July 15th, 2025, and we're diving into Wells Fargo's second quarter earnings report. Joining us is John, a senior analyst from Smart Stock Watch. John, thanks for being here.
Thank you for having me. Wells Fargo's Q2 2025 results are quite intriguing, and I'm excited to break them down for our viewers.
Revenue and profitability overview. Let's start with the top line. Wells Fargo reported a revenue of $20.8 billion for Q2 2025, which is a 1% increase from last year. However, net interest income saw a decline. John, can you elaborate on these figures?
Absolutely. The revenue growth is modest, but it's important to note that net interest income decreased by 2% to $11.7 billion. This decline is primarily due to lower interest rates impacting floating rate assets and changes in deposit mix. Despite this, Wells Fargo managed to achieve a net income of $5.5 billion, translating to an adjusted EPS of $1.60, which beat the forecast of $1.41 from 10 analysts.
That's impressive. Beating the EPS forecast is always a positive sign for investors. Operational efficiencies and future outlook. Wells Fargo's efficiency ratio stands at 64%, and non-interest expenses have increased slightly. How does this impact their operational efficiency and future outlook?
The efficiency ratio of 64% indicates that Wells Fargo is managing its expenses well relative to its revenue. Non-interest expenses rose by 1% to $13.4 billion, but the company has maintained a pre-tax, pre-provision profit of $7.4 billion, also up by 1%. Looking ahead, Wells Fargo expects its net interest income for 2025 to be roughly in line with 2024, which suggests stability in their core operations.
Stability is key, especially in the current economic climate. It's good to see Wells Fargo maintaining a steady course. Credit quality and capital position. Credit quality and capital position are crucial for any bank. Wells Fargo's provision for credit losses is at $1 billion, and their CET1 ratio is 11.1%. What does this tell us about their financial health?
Wells Fargo's provision for credit losses remains stable at $1.0 billion, with net loan charge-offs decreasing by $304 million. This indicates improved credit quality. The CET1 ratio of 11.1% and a liquidity coverage ratio of 121% reflect a strong capital position, ensuring that Wells Fargo is well prepared to meet regulatory requirements and withstand economic fluctuations.
It's reassuring to see such robust capital and liquidity metrics. It certainly positions Wells Fargo well for future challenges. Strategic initiatives and market position. Wells Fargo has been active with strategic initiatives, including stock repurchases and dividends. Can you provide more details on these actions?
Wells Fargo repurchased $3.0 billion in common stock during Q2 2025, which is a significant return of capital to shareholders. They also paid a dividend of 40 cents per share and expect to increase it to 45 cents per share in the third quarter, subject to board approval. Additionally, the acquisition of the remaining interest in their merchant services joint venture resulted in a $253 million gain, enhancing their non-interest income.
These strategic moves certainly strengthen Wells Fargo's market position and shareholder value. Key takeaways. In summary, Wells Fargo has delivered a solid performance in Q2 2025, with revenue growth, a strong capital position, and strategic initiatives that enhance shareholder value. John, any final thoughts?
Wells Fargo's ability to beat EPS expectations and maintain a strong capital position is commendable. Their strategic initiatives, including stock repurchases and dividend increases, further solidify their market standing. It's a positive outlook for investors.
Thank you, John, for your insights. And thank you to our viewers for tuning in. Don't forget to like, share, and subscribe to Smart Stock Watch. We'd love to hear your thoughts on Wells Fargo's performance in the comments below.